Before every big move, the market fires a warning shot. One candle, the pin bar, and you've been scrolling right past it. However, that wick doesn't mean what you think it means. Let me show you how most traders read pin bars versus how smart money creates them. Most traders see this setup and think textbook reversal. Long wick shows rejection, small body shows indecision, and the close near the opposite end suggests new direction. Every trading book teaches this interpretation. But smart money sees something completely different. They see a successful liquidity operation. They needed to trigger stops sitting above that level, and they needed other traders to provide selling pressure for their accumulation. The pin bar accomplished both goals perfectly. Here's the reality most traders never consider. Before that pin bar formed, smart money knew exactly where retail stops were clustered. They engineered the price spike specifically to trigger those stops and create the liquidity they needed for their real position. Watch what happens next in most of these setups. While retail traders are entering short positions based on the reversal signal, price starts grinding higher. Not immediately, but steadily. That's smart money absorbing all the selling pressure their pin bar generated. You probably didn't notice this, but the most profitable pin bar setups happen at levels that look too obvious. These aren't accidents. Banks target these levels because they know that's where most traders will place their stops. Does this sound familiar? You see the perfect pin bar, enter your trade, watch it go your way briefly, then watch it slowly grind against you until you're stopped out. That's not bad luck. That's the bank strategy working exactly as designed. But it gets even more interesting when you understand the timing element. Here's the reality. Most pin bars fail because they're designed to fail. When you see a perfect-looking pin bar at what appears to be a key level, your brain immediately starts calculating the risk-reward ratio. The entry looks obvious, the stop-loss level is clear, and the profit target seems reasonable. This is exactly the thought process banks wants you to have. Please remember this. The psychology of failure starts with pattern recognition. Humans are wired to see patterns and assume they'll repeat. Trading education reinforces this by showing you historical examples of pin bars that worked perfectly, but they don't show you the majority that failed or the context that made the difference. Most traders fail with pin bars because they focus on the pattern instead of the market dynamics. You see the long wick and think rejection, but rejection of what, by whom, and for what purpose? Without understanding the forces behind the pin bar formation, you're trading blind. The emotional component makes failures worse. When a pin bar trade goes against you, the natural response is to hold longer because the setup looked so perfect. The longer wick makes you think the rejection was stronger, so the reversal should be more powerful. This keeps you in losing trades longer than you should stay. Fear of missing out drives many pin bar failures. When you see what looks like a perfect setup, the urgency to enter overrides proper analysis. You don't wait for confirmation or additional context. You jump in based on the pattern alone, which is exactly what banks expect you to do. Let me show you two identical pin bars that produced completely opposite results. These two pin bars that look exactly the same. Same long wick, same tiny body, same perfect setup. Here's the first one. Beautiful bearish pin bar at what looks like resistance. But look closer. This pin bar formed in the middle of a strong uptrend. Price has been climbing for weeks. Now here's what happens next. Price drops for a few candles, then rockets higher. The pin bar failed because it went against the bigger picture. Now check this out. Here's the second pin bar. Looks identical, but this one formed after price shot straight up with crazy speed. The trend was getting tired. Volume was dying. Watch what happens. This pin bar actually works. Price reverses hard and keeps falling. Same pattern, totally different result. It's not about the pin bar itself. It's about where it happens. The market was already trending up strongly in the first example. That pin bar was just a small pause in a big move higher. Fighting that trend is like standing in front of a train. But in the second example, the market was already showing weakness. The pin bar was just the final proof that buyers were done. This is huge. The location of your pin bar matters more than how perfect it looks. A pin bar in a strong trend usually fails. A pin bar when the trend is getting weak usually works. Remember this. Context determines everything. Market structure, volume, trend strength, and previous levels all matter more than the pin bar pattern itself. Most traders focus on the pin bar and ignore everything around it. But the everything around it is what determines whether the pin bar succeeds or fails. In strong trending markets, pin bars often represent temporary pullbacks rather than reversals. The trend remains intact, and the pin bar simply shows where buyers or sellers stepped in to defend the trend. Trading these pin bars counter-trend is usually a losing strategy. Range-bound markets create different pin bar dynamics. Pin bars at range boundaries often do represent genuine reversals because there's no strong trend to overcome. But pin bars in the middle of ranges are usually meaningless noise. But here's where the real money gets made, when you learn to read what those wicks are actually telling you. Most traders make this critical mistake. They see all wicks as equal. Big wick means big rejection. Small wick means small rejection. And this oversimplification costs them money. Here's what matters most. How big is the wick compared to the whole candle? Look at this pin bar. The wick is huge, but the whole candle is also huge. That wick is only 30% of the total size. Not that impressive. Now look at this one. The wick is smaller, but it's 70% of the whole candle. This shows much stronger rejection. Size matters, but only compared to the rest of the candle. Speed tells you everything too. Did that wick form fast or slow? Fast wicks mean someone jumped in hard. Slow wicks mean things change slowly. Fast is usually more powerful. Watch for wicks that touch the same spot. When you see 3 pin bars with wicks hitting the same level, that's huge. That level is defended. It's not just one rejection. It's a rejection zone. Look where the candle closes to. Does it close near the wick or far away? Close to the wick means weak follow-through. Far from the wick means strong conviction. Some pin bars have wicks on both ends. That shows a fight with no winner. Pin bars with wicks on just one side show a clear winner. Another tip, big wicks in calm markets mean more than big wicks in crazy markets. Everything is relative. I hope you see that a candle wick isn't just price action. It's the markets telling you exactly what happened. Order blocks and pin bars work together to create high probability setups. You see, banks don't just place orders randomly. They go back to the same spots over and over. These spots are called order blocks. When price returns to these areas, pin bars often form. And that's not coincidence. Here's the reality most traders never see. When a pin bar forms at an order block, it's usually smart money finishing what they started. They placed big orders there before. Now they're back to complete the job. Think about it like this. Banks leave unfinished business at certain levels. When price comes back, they finish that business. The pin bar shows you exactly where they finished, and volume tells you if it's real or fake. Big volume during the pin bar at an order block means smart money is active. Low volume means nothing important is happening. The strongest setups happen when price tries to break through an order block and fails. Then it forms a pin bar right there. That's the order block fighting back. The zone is being defended hard. Also, fresh order blocks work better than old ones. If an order block has been tested many times, it gets weaker. But a fresh order block that hasn't been touched yet, that's where the real power lives. You're starting to see how the pieces fit together. Pin bars aren't random patterns. They're smart money signatures at important levels. And this technique is powerful on its own, but it becomes unstoppable when you combine it with volume profile analysis. So picture this situation. You've identified a perfect pin bar setup, but you want additional confirmation before risking your money. You need to know if this level has real significance. The problem is, most traders don't know how to validate their pin bar signals. As I said, they enter based on the pattern alone and hope for the best. But imagine if you could see exactly where the most trading has occurred, historically. Imagine knowing which levels have true institutional significance and which are just random price action. The result is volume profile integration with pin bar analysis. This combination shows you where banks are really positioned. Here's the key insight. Pin bars at high volume nodes are infinitely more reliable than pin bars at random levels. These are areas where serious money has been deployed previously. High volume nodes that coincide with pin bar formations are revealing areas of significant institutional interest. These are simply price levels where a ton of trading happened in the past. Think of them as price magnets, where banks have an interest. Point of control interactions with pin bars provide some of the highest probability setups in trading. This is the single most magnetic price in that session. When pin bars form at or near the point of control, they often indicate where the most trading has occurred and where future reactions are likely. Value area boundaries combined with pin bar formation show whether current price levels are sustainable. These setups help you distinguish between temporary reactions and major reversals. This isn't just another indicator combination. It's a complete transformation in how you read institutional order flow through price action. Rewatch this chapter and take notes, because this is really important. You now have the individual components: smart money psychology, liquidity hunting, volume analysis, and context awareness. Here's how they work together as a complete system. Start with market structure. Identify the current trend, key levels, and areas where stops are likely clustered. This gives you the foundation for everything else. Next, watch for pin bars that form at structurally significant levels. These are the setups where banks are most likely to be active because they provide the best liquidity hunting opportunities. Then apply volume analysis to distinguish between genuine and engineered pin bars. High volume pin bars at key levels deserve attention. Low volume pin bars at random levels can usually be ignored. Take a close look at high volume nodes. These will act as magnets for price. When pin bars form at these levels, you already know these aren't random rejections. They're calculated defenses of important prices. Finally, use context to determine whether the pin bar represents continuation or reversal. Strong trends produce continuation pin bars. Weak trends or range-bound markets produce reversal pin bars. The system works because each element confirms or contradicts the others. When all elements align, you have high probability setups. When elements conflict, you have low probability setups that are better avoided. And guess what? Most pin bars fail this multi-factor analysis. And that's good. You want to trade only the highest probability setups where everything aligns perfectly. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for. Link is in the description.